I hope you had a wonderful day. Our class tonight is going to be very direct because what I want to achieve is to finish up with IFRS 16. And we have done the major part of the work in our last class. So for IFRS 16, that talks about leases, we learned that in a lease contract, there are majorly two parties, the lessee and the lessor. The lessor is usually the owner of the assets, while the lessee is the tenant or the party that has the right to use the asset. So when you have a contract and you find out that the lessee has right to control the assets, then that contract is a lease contract. And when we say the lessee has right to control the assets, it means that the lessee has right to obtain substantially all the economic benefits from that asset. And also the lessee has right to direct the use of the asset. A lease contract is usually for a period, which we call lease term. And this lease term is a non-cancelable period. We don't expect it to be cancelled, but it can be extended. It can be extended. And when you are accounting for leases, you are going to consider that period of extension if it is favorable for the lessee to extend. If it is favorable for the lessee to extend, you consider that period of extension when you are accounting for leases. Then we went on to lessee accounting. I told you that for the lessee at the commencement date will recognize right of use assets and a lease liability. And I told you that it's going to measure these two at the present value of unpaid lease rentals. However, for the right of use assets, if there are any amounts paid at the commencement date, it will be added to the right of use asset. If there is any directly attributable cost that are related to bringing the asset to its location and condition, it will be added to the right of use asset. You see, the lessee is able to credit lease liability right from the commencement of the lease because as soon as he enters into a lease contract, he has an obligation to pay the entire amount in that lease contract over the lease term. He has to pay because the lease term itself is non-cancelable. So he has the liability and the assets. The lessee has right to control the asset for that period, so you can recognize that in his books as well. At the end of the year, the liability would reduce with the annual rentals. So we debit the liability with credit bank. Also, at the end of the year, we're going to unwind the discount because whenever we discount future values to present value, whenever we discount them to present value, and we put that present value in our books, you see, as we move through time, as we move into the future, or at the end of each year, you need to start unwinding that discount. You need to start increasing that amount. That's what I mean by unwinding the discount. And you do that through finance cost for a liability. should be the discount rate multiplied by the opening liability. That gives you the discount. The discount goes to P&L as finance cost, and you increase the liability with it. So that when you get to that point in the future, is that future value you would achieve, that future value that you discounted. So this unwinding of discounts will ensure that that present value becomes that future value in the future. It's important it becomes it. Like I told you, for the right of use asset, if there is any amount paid at the commencement date, it will be added to it. And at the end of the year, we simply depreciate the asset per annum. That's for the lessee accounting. For the lessor, I told you that the major accounting issue here is that should the lessor remove the asset from his books or not? Remember, the lessor owns the assets. The asset will naturally be in the books of the lessor. So since he has leased it now, the key question is that should he remove this asset from his books or should he leave it there? I told you it depends on the class of lease he has entered into. If he has entered into a finance lease where there is a transfer of risk and reward attributable to that asset, he is expected to remove that asset from his books. But where the lease is an operating lease, where there is no risk and reward transferred, he can still leave the asset in his books. And I told you there are 5 indicators that shows that this is a finance lease, that shows that the lessor has transferred risk and reward. I told you about where there will be transfer of ownership at the end of the lease term, or where the lease term is almost equal to the useful life of the asset, or where the PV of lease rental is almost equal to the fair value of the asset, where there is a purchase option, where the asset is of specialized nature that only the lessee can use it without significant modification. These are indicators of a finance lease. Then I went on to how do you then account? If it's a finance lease, how do we account for it? You see, the first thing the lessor would do is to remove the asset from his books, because finance lease is very close to the lessor, like being it's as good as he has sold the asset, even though technically he hasn't, but it's close to that. So it derecognizes the asset from his books, and he will recognize the lease receivable or a net investment in the lease. The lease receivable or net investment in the lease is computed by determining the present value of unpaid lease rentals and also adding the present value of unguaranteed residual value. We explained all of this to you. And I said at the end of the year, the lessor will receive rents. Their rent will reduce the lease receivable. So we credit lease receivable and debit bank. Also, it would unwind the discounts because the lease receivable is determined by present value. So you need to unwind it. So since this lease receivable is an asset, we're going to unwind it with finance income. So we credit finance income with debit lease receivable. And we can do that with this schedule. For operating lease, the lessor don't have to derecognize the assets in this case. All you recognize is a rent received that he recognizes in P&L on a straight line basis. That was all the explanation I did last week. Today is just to solve questions. So let me go to the first question here. It says, on 4th January 2002, Network Limited bought a plant from Password Limited under a lease contract. The terms of the lease requires Network to make 4 annual installments of 2 million naira each, payable at 31st December. The present value of lease payment is 5.7 million. The interest rate implicit in the lease is 15% per annum, and it is estimated that the plan should be economically productive for 5 years. There is an opportunity to extend the lease term at conditions favorable to the net worth. The reporting date of net worth is 31st December. Show the financial statement extracts of net worth limited over the relevant periods. When you see a requirement like this in the exam, you have to be careful because they said you should show the financial statement extracts. So that means you need to prepare P&L and statement of financial position at least at basic. You need to prepare those two. So any other thing you do before those will just be your workings. So this question now, you will see that we are required to prepare this financial statement extract for net worth. So who is net worth? Net worth bought a plan from Password under a lease contract. That means net worth is the lessee. He bought a plant. He is the lessee. So they want us to account for the lessee. Net worth will pay 2 million per annum and is paying at the end of the year. So you need to be very careful because if it's paying at the beginning of the year, a lot of things will change. This is paying at the end of the year. They already gave us the PV of lease payments. They already gave you. So if they don't give you, you have to compute it. Very straightforward. You use this annuity formula. 1 minus 1 plus r raised to power minus n over r. Whatever you get, you multiply it by this annuity, the annual amount, should give you something very close to this. We're given the discount rate of 15%. We're given the useful life of the asset of 5 years. I mean, I can see that the lease time here is 4 years because this guy is paying for 4 years. He said there's an opportunity to extend the lease term at conditions favorable to net worth. So we can extend the lease term at conditions favorable to net worth. This saying that you can extend at conditions favorable to net worth shows that we would extend, shows that you need to consider the period of extension. For this statement, because of this statement, it means that the lease term will not be 4 years anymore. Because they told us that you can extend at conditions favorable to net worth. That means he's going to extend this lease to the useful life. He cannot extend beyond the useful life of the assets. That will not be economically reasonable. So that means the new lease time now is 5 years, not 4 years anymore. It's now 5 years because they said they can extend under conditions that are favorable to net worth. Okay, I have all the information I need. And let me remind you, for a lessee, all the lessee does is to recognize lease liability and right of use assets, and usually measures these two at the present value of unpaid lease rentals at the commencement date. And from here, this is the present value of unpaid lease rentals. So that means at commencement date, this is what you will recognize in his books, 5.7 million. A credit 5.7 million to lease liability. A debit right of use assets with also 5.7 million. So what happens at the end of the year? Let's start from 2002. At the end of 2002, we'll have balance brought forward 5.7 million. You add the interest at 15%. Don't remember this 15%, the discount rate. So we simply apply that 15% on 5.7 million. It gives us 855,000. When you add these two together, you get 6,555,000. At the end of the year also, we are going to pay rent. So we deduct 2 million. So it brings the balance down to 4,555,000. This balance, we are going to carry it forward to 2003. As you can see, in 2003, our lease liability is now 4.5 million. Again, you are going to apply the 15% discount rates on that 4.4,555,000. Brings our interest cost to 683,250. When you add the two together, you get 5,238,250. Again, we also pay rent, so we remove it. It brings our lease liability down to 3,238,250, which you carry forward to 2004. Again, you apply your 15% interest on that 3,238,250. You get 485,738. You add the two together, you get 3,723,988. You remove your rent of 2 million, brings it down to 1,723,988, which you would carry to next year again. You apply the interest on that, we get 258,598. You add them together, brings it to 1,982,586. You pay your rent, so you remove it. It's bringing it to negative. Ordinarily, it should be zero. Okay, why you're having something like this is because of the opening. This 5.7 million at the beginning was an approximation. That's why you're having minus 17,414 at the end. Okay, but this is generally how you do the lease liability schedule. Then you go to the right of use assets. The right of use asset would also be measured the same way as you measure the liability at the beginning, which is the PV of the unpaid lease rentals. That gives us 5.7 million. We don't have any amount paid at the commencement date, so that's zero. We don't have any direct cost, direct attributable cost. We don't have any decommission, so all of those are zero. So that means the cost of this right of use asset is 5.7 million. This we're going to depreciate over the lease term. Remember, the lease term is now 5 years. Since the lessee can extend, so the depreciation per annum is 5.7 million divided by 5 years. So it brings our depreciation to 1,140,000. And that is all the workings you need to do. Very, very straightforward. It's always, the leases are always direct. It's not more than this. Then let's prepare our statements. My P&L, for my workings, what goes to P&L from this schedule, lease schedule, is just the interests. It's just the interest. So the lease interests, you will see that in 2002, 855, 2003, 683,250, 2004, 485,738, 2005, all of those figures we got from our schedule here, from this 855, they all go to P&L. Secondly, the item that also go to P&L is this depreciation. So the depreciation, you see that is equal amount every year, because all we just did is to spread the cost over the lease term. So equal. In my statement of financial position, I have my non-current assets. So I have my right of use assets. The cost of an item of PP is equal all through. So 5.7, 5.7 like that. You deduct accumulated depreciation. You see that in year one, the accumulated depreciation was 1,140,000. You see that in year 2, it has doubled, like, because it's cumulative, it has increased by the 1.140. In year 3, it increased again by 1.140, like that, until the end of the lease term, where they nil off eventually. But you should have knowledge of that under PP already. So you get your, by the time you do cost minus accumulated depreciation, you get your carrying amount for each year. Now, for the liability, we separated the liability into current and non-current. So why is this done this way? The reason is that if you look at 2002 here, if you look at 2002, the liability for, our liability for 2002 is 4,555,000. And this liability, we are paying it, like, we'll pay some in 2003, some 2004, some in 2005. You see, according to our years 1, when the payment of a liability is due within 1 year, we say that liability is a current liability. But where the payment of a liability is due after more than 1 year, we say that liability is a non-current liability. In the case of this 4.5 million in 2002, it has elements of the two, because we are paying rent every year in this case. So out of this 4.5 million, we have to pay, some portion of this liability is due next year, but we are not paying everything next year since we pay annually. And the remaining portion will be due after 1 year. For that reason, we would need to identify how much is payable next year. That becomes our current liability. Then the remaining becomes the non-current liability. See, the easiest way for you to do this in the exam, this separation of this 4.5 million between current and non-current, the easiest way for you is for you to look at, okay, in 2002, my liability is 4.5 million. So what portion is current? Since you have already done the spreadsheet, the schedule all through the life, you can look at 2003 and see that your liability has reduced to 3.2, which means that the difference is what you must pay next year, which means that the difference between this 4.5 and 3.2 gives you your current liability, because that is what you must pay next year. As soon as you get your current, just remove that from the 4.5 million. It gives you a non-current. And coincidentally, not even coincidentally, it will always be this 3.2 that will be the non-current, because that is what will remain. The same thing. In 2003, this 3.2 million, I can also split these into current and non-current, this 3.2. That, okay, I'm in 2003. My liability is 3.2. This 3.2, some portion will be paid next year. Some portion will be paid after more than 1 year. The best way to split it, that, okay, I'm owing 3.2 in 2003. I look at 2004 for my spreadsheet. I saw that it has reduced to 1.7. Yes, that means that I have to pay the difference next year for it to be reduced to this. So the difference between this 3.2 and 1.7, that's the current liability. When you get that difference, just remove that difference from this 3.8, from this 3.28, that becomes your non-current. That becomes your non-current. And in 2004, my liability of 1.7 million, I can also split that. But fortunately for you, I have to pay this 1.7 million next year, because that's the end of the lease term. That means this 1.7 million is entirely current. Is entirely current. So everything is current liability. And that's the split I did here into current and non-current. So this one of current liability is just the difference between the year 2 liability and year 1 liability, while the non-current is the balance. The same thing for year 2. Year 3 minus year 2 liability gives me the current. All this 1.7 is the balance. In year 3, everything becomes current because I have to settle this entire 1.7 next year. And that's the end of this question. That's the end of this question. Says the company enters into a 4-year lease commencing on 1st January 2001 and intends to use the asset for 4 years. The terms are 4 payments of 50,000 commencing on 1st January 2001 and annually thereafter. The interest rates implicit in the lease is 7.5%, and the present value of lease payment not paid at 4th January 2001, that is 3 payments of 50,000, discounted at that rate is 130,026. Legal costs to set up the lease incurred by the company were 402. Show the lease liability from 4th January 2001 to 31st December 2004 and explain the treatment of the right of use assets. Okay. So for this one, the question is quite specific. It wants us to show the lease liability from 4th January 2001 to 31st December 2004. And they want us to also show the treatment of right of use asset. So this is a 4-year lease and it's commencing at the beginning of 2001. So we want to use the asset for 4 years. The lessee is expected to pay 50,000 per annum for 4 years, but this payment in this case is going to commence on 1st January 2001 and annually thereafter. See, the major thing in this question is that the rent is paid by the lessee at the beginning of every year. That's the only difference between this question and the last question I solved. The last question I solved, if you paid attention, the rent is paid at the end of every year. So you need to pay close attention to the difference. The interest rate is 7.5%. They give us the PV of lease payment not paid at 4th January 2001. That is 3 payments of 50,000 discounted at that rate at 130,000. Okay. So why are they giving us the PV of just 3 payments where we are supposed to make 4 payments? So the only reason is this, because the rent is paid at the beginning of every year. That means that from the beginning of the year, we are not owing 4 payments anymore. We are only owing 3 payments. And that's why when they give us the PV of the future payments, the first payment we have settled will not be included, of course, because that has been settled. And that's why they only give us the PV of just the remaining payments of this. They give us legal costs of 402. Okay. They want us to do the lease liability. You see, at commencement date, the lease liability is valued at this, 130,026. 130,026. But at the end of the year, from 2001, we will say at the beginning, we were owing 130,026. The lease payment is going to come first. Why? Because we are paying at the beginning of every year. Though in the first year, it's going to be 0 because, I mean, this 130,026 is exclusive of the first payment. We are not owing it. So it should not be included there anyways. That's why the lease payment in year 1 is 0 because it has been paid. So it's not included in this liability. Then interest. Interest is applied on 7.5% of this 130,026. Then that gives us 9752. When you add the two together, I give you 139,778. You see, you need to be very careful. The last question we solved, the interest came first before the lease payment. This one, the lease payment came first before the interest. They won't give you the same answer. They won't. because in this case now, interest is calculated on the net after deducting rent. In that other one, when payment is made at the end of the year, interest is computed on the opening. It won't give you the same interest figure. You have to be very careful. So this 139,778, we'll carry it to next year. So in the second year now, we can remove our rent that we paid, which brings our liability to 89,778. We can then apply the interest because the interest is happening at the end of the year, while payment is happening at the beginning. So it's logical to remove the payment first. Unlike where payment is made at the end, so we need to add the interest, then whatever is remaining we settle. That's why that was like that in that case. So when we apply 7.5% on 89,778, we get 6,733. You add these two together, you get 96511, which you carry to next year. We remove our payments. It brings it down to 46,511. You apply your 75% on that, you get 3,488. You add the two together, 3,488 plus 46,511, approximately 50,000, which you carry to next year. Then we pay it off. Everything becomes zero. This is the lease liability. The right of use asset is also measured at the present value of unpaid lease rentals, which is 130,026. We add amount paid at commencement date, which is 50,000. We add directly attributable cost, which is 402. Brings the total to 140, 180,428. So you need to take note of this, how to calculate cost of right of use. This is complete. The PV of unpaid lease rentals, amount paid at the commencement date, directly attributable cost. In this case, it was this legal cost of 402. Okay, when you add all together, you get this. Then you can then depreciate that cost over the lease term. So when you do 180,428 over 4, you get this. Okay. I'll send you more questions as assignments, classworks, but it's always like this. There is nothing more beyond this. Now, for lessor accounting, let's look at this illustration. Illustration 5. This one says that a lessor enters into a 3-year leasing arrangement commencing on 4 January 2003. Says that under the term of the lease, the lessee commits to pay 80,000 per annum commencing on 31 December 2003. A residual guarantee clause requires the lessee to pay 40,000 or 40,000 less the asset residual value, if lower, at the end of the lease term, if the lessor is unable to sell the asset for more than 40,000. The lessor expects to sell the assets based on current expectations for 50,000 at the end of the lease term. The interest rate implicit in the lease is 9.2%. The present value of lease payment receivable by the lessor discounted at this rate is 232,502. Required. Show the net investment in the lease from 4 January 2003 to 34 December 2005 and explain what happens to the residual value guarantee on 34 December 2005. Okay, this is also another direct question. Now, wants us to determine the net investment in the lease from 4 January 2005 2003 to 31st December 2005. And it wants us to explain what happens to the residual value guarantee on 31st December 2005. Okay, good. Very good question. Remember that net investment in the lease is calculated at the PV of unpaid lease rentals plus the PV of unguaranteed residual value. And from this question, a lessor enters into a 3-year lease starting from 4th January. The lessor will get 80,000 per annum at the end of every year. And we're told that the residual guarantee clause requires the lessee to pay 40K at the end of the lease term. So usually, I have explained this before anyways, that the lessee can guarantee the lessor a residual value. In this case now, he has guaranteed him 40,000. But if you look at the next paragraph, they said the lessee expects to sell the asset based on current expectation for 50,000. That means that the lessor believes he can get much more than what the lessee has guaranteed him. He believes he can get 50K. That means there is an unguaranteed residual value of 10,000, which is the 50K minus the guaranteed, that the lessor needs to consider. In the final paragraph, they gave us the discount rate, and they also gave us the PV of lease payments of 332. If they don't give you this 232, the way you calculate it is to get the PV of this 80,000 per annum using an annuity formula, and also the PV of this 40,000, which is the guaranteed residual value. When you get the PV of the two, that's what will add up to this 232502. But in most questions, like the ones I'm also going to send to you, you'll find it there. Even though most of you in this class don't submit assignments. Now, the net investment in the lease at the beginning of the lease, we'll get the PV of the lease payments as given in the question, 232502. You also get the PV of unguaranteed residual value. I've told you that the PV of unguaranteed residual value, first, the unguaranteed residual value is 10,000. You discount it to present value, which is 1 plus r raised to power minus 3. This one, you don't need an annuity formula because this 10,000 is payable or is receivable in 3 years. So you just use normal discounting formula to get the present value of that. So that's why we have 1.092 raised to power minus 3 being discount rate of 9.2%, this term of 3 years. That gives us 7679. When you add this to the PV, it gives you 24181 as the net investment in the lease. Then at the end of the year, from 2003, the opening is 24181. You add finance income of 9.2% on this 24181. You get 22,097. You deduct your lease income of 80,000. It brings it down to 182,278, which you are going to carry forward to next year. Again, you apply 9.2% on this 182,278. It gives you 16,770. You add the two together, it gives you 199,047. You again remove your rent of 80,000. It brings it down to 119,047. You carry it to next year. You apply 9.2% on this, it gives you 10,952. You add it together, that's 130,000. You remove your rent, your rental income of 80K, you have 50,000. And that's all. You see, this 50,000 is exactly the residual value of 50,000 that the lessor believes he can get. And you see, out of this 50,000, the lessor, the minimum he will get is 40K, because this 40K has been guaranteed by the lessee, which means that if, for example, the lessor believes he can get for 50K, right? So let's say he struggled and struggled. He could only sell the asset for 20,000. What happens is that the lessee will have to top it up by 20, just so that he can get the minimum guaranteed residual value. Even if he's unable to sell it at all for any amount, the lessee will still give him 40,000. But if by chance he's able to sell the asset for 50,000, good for the lessee. That means the lessee is not going to give him anything, because, I mean, he was able to sell the asset and get the money. The idea is that he is guaranteed 40K, that whatever happens, so he will get 40K. So the lessee is ready to do that, and he has made that commitment right from the beginning of the lease. So that's what happens to this 50K. Ultimately, it depends on what happens, but at least at worst, he will get 40K. But we don't have such the full information for now. And that's the end of this question. I mean, some question can ask you, not just for this, they can ask you to prepare P&L and statement of financial position. In this net investment in the list, the only thing that goes to P&L is just the finance income that goes to P&L. And when you see this balance of 182,278 at the end of the year, that simply goes to your statement of financial position under non-current assets. It goes to your statement of financial position under non-current assets. In year 2, in 2004, again, your finance income goes to P&L, while this 119 will go in as under your assets in the statement of financial position. Then now it can come under current assets, because it's just 1 year to go. We are expected to recover all our money within 1 year. Okay, I won't solve this question because it's the same thing as this one. It's the same, nothing, there's no difference at all. Now, let's look at this very short illustration for operating lease. Operating lease is very straightforward. There is nothing difficult about it. If you remember the principle I taught you, I said you recognize operating lease on a straight line basis. You would recognize the rental income on a straight line basis equally every year. And majorly that's all. So in this case now, we have a lessor that lease a property to a lessee under an operating lease for 5 years at an annual rent of 100,000. If they had stopped here, if they have stopped this question here, then this question becomes straightforward. Because it simply means that we would just recognize 100,000 to P&L every year. But they won't stop there. They will want to put some test for you just to be sure that you understand the principle. And they say that, however, the contract states that the first 6 months are rent-free. The first 6 months are rent-free. Which goes to show that in the first year, the lessor will only collect 50,000. Since first 6 months is rent-free, he will only collect 50,000. Then in subsequent years, he can be doing 100,000 in subsequent years. So it would be wrong for us to now recognize 50,000 rent that we received through P&L in the first year and recognize 100,000 in subsequent years to P&L. That would be against the core principle of operating lease that requires that we recognize the rent on a straight line basis. That requires that we recognize the rent equally to P&L. So the only way to achieve recognizing recognizing rent. Rent recognized to P&L. The only way you can make sure that you recognize equal amount to P&L is for you to look at, okay, how much is remaining for me to receive? Just divide that by the lease time, spread it over the lease time. In this case now, the amount receivable, being that we have given 6 months free for the first year, that means in the first year, we are expecting 150,000. In the second to fifth year, we are going to be getting 100,000. So what we're expecting over the lease term is 450. Just divide this 450 by the lease term, which is 5 years. That gives you 90K, 90,000. Is this 90,000 you recognize to P&L every year? And that is it. But you have to be very careful, because when you recognize this to P&L, which means that you are going to credit POL. What do you debit? My class is almost over. Can anyone tell me what you're going to debit? Lease receivable. Because it's not 90,000 you will collect in the first year. What you are collecting in the first year is 50,000. That means that you are recognizing 90K to P&L, but you are collecting 50. That shows that in addition to recognizing this to P&L, you must do well to recognize a balance of 40,000 as lease receivable in the first year. So that means you should have like a lease receivable, which is an asset account, that, let's say in year one now, let's say this is dash, you recognize 90K to it, that you recognize in year one that you're expecting, but you only received how much? 50K. That means there's a balance of 40K. This balance of 40K, you must recognize it as, you can recognize it as a non-current asset, because you might not receive it next year. While this one goes to P&L. So the core principle of operating lease is straightforward, but don't just recognize this, the 90K to P&L every year, and forget that there might be a balance, because what you are recognizing to P&L is not what you receive. So there will be a balance. So if I want to show you for the whole 5 years now, in year two, that means we'll bring forward this 40K. Again, in year two, again, you recognize 90K to P&L, but now we're going to collect 100K. By the time you do 40 plus 90 minus 100, that means your receivable becomes 30. Again, in year three, you bring forward the 30. You recognize 90K. You collect 100. You have a balance of 20. In year four, you bring forward 20. You recognize 90. Cash off 100. 20 plus 90 minus 100. You have a balance of 10. In year five, you have 10,000. You recognize 90. You receive 100. You have a balance of zero. So ultimately, over the years, it's going to balance out. But they might not, I mean, if the examiner asks you to do this, they will definitely specify. But I'm seeing a question like this as part of your published question, probably in question one. They will just put this kind of question as an additional information. So you recognize 90K, 90,000 to P&L every year, while not forgetting that what you receive is not the same thing as what you have recognized. There will be a balance of 40,000. Okay, I'm going to stop here for tonight. Do you have any questions? Do we have any questions? All right. So, I mean, a lot of you haven't submitted your assignments in this class. Please go and read. Instead of teaching. You're not making effort to revise. I mean, go and try to do that. I'll see you guys next class. Bye.